Good afternoon and welcome. Today's discussion features Peter Torrente, KPMG's National Sector Leader for Banking and Capital Markets, and our guest, Michaud, President and CEO of KBW. KBW, an investment bank focused on the financial services sector, is a subsidiary of Stifel Financial. KBW's highly regarded bank research team has the broadest coverage of the banking industry on Wall Street, covering not only the nation's largest banks, but most of the leading regional banks as well. And now for our presentation.
Tom, welcome. I hope you're having a great summer so far. Hard to believe we're halfway through 2022. I know we have second quarter earnings about to kick off later this week into next week, and I know everyone really looking forward to your comments on that. But maybe before we get to the quarter, given there's so much going on with inflation, talk of recession, and so forth, maybe we start off with just your views on the macro economic environment and just the macro environment in general.
Well, first of all, Peter, great to be with you again, and thank you for inviting me to join you for this presentation. I would say the macro environment is about as uncertain as I've seen it in my career, and it's interesting because there's no calamity really afoot right now. It's really a lot of worry about what's going to happen over the next 6 to 9 months. We are right now in the middle of a period with significant change to monetary policy. The pace at which we're seeing the Fed tighten really is historic. And investors and market participants and bank managements know that what we saw in the first quarter, the last financial statements that we've seen, is really a world that's in the rearview mirror. It's important to see what's going to happen to the trend lines over the next couple of quarters as the economy slows down. Remember, that is the stated goal of the Fed, is to defeat inflation and slow the economy to do that. And investors are very concerned about what the impact is going to be on the banking and financial services industry as that happens. So what's very interesting is that the world that investors are worried about at year end and the quarter that we're about to see, in many cases, could be quite different. But that's the gap that I see opening up right now, and it's just the concern about whether or not the Fed can be successful in delivering a soft landing, or if we get something more severe, how much more severe is it going to be?
Tom, you mentioned the quarter. What do you see as the moving parts and the drivers for the quarter that we're going to hear about over the next couple of weeks here?
Sure. So I think it really depends upon what type of banking company you are for the banks. That'll determine really what your quarter is going to look like. Maybe I'll start with the ones that I think that are going to be a little bit more challenged. There are pockets of the financial services industry that are already being dramatically impacted by Fed policy and what's happening in the overall economy and markets. So maybe we would start with the mortgage arena, for example. Our latest forecast is that mortgage originations are going to be down 41% for this year, and then we think it'll be down another 6% next year. So that's going to be a big headwind, and that's for a full year forecast, but the headwinds are here and now in the second quarter. So if you're a mortgage banking business or a mortgage bank, you're going to feel a lot of pressure on that side. Also, if you're one of the nation's biggest banks, and these are the banks that typically report first, you generally have a very large investment banking operation. And those businesses have been significantly impacted by what's happening in markets and in the overall economy. We think that investment banking revenue will be down 50% on a median basis year over year. You're going to see tremendous pressure in equity capital markets, which should be down 80% year over year, as those markets have essentially been closed for capital raising. Debt capital markets has been weak as well. The offset is that there's been very good trading performance, we believe, especially those that are in the FICC arena, FICC, which is really fixed income commodities and currencies. is going to show, I think, a good quarter, as well equity trading, as volumes have been up and volatility has been high. So if you have an investment banking business, that's going to provide a little bit of a headwind. But when you get to the core banking business, there's lots of positive operating leverage that's underway. We're looking for about 12 basis points of margin improvement for the median bank. We research over 200 of them. We're also looking for 10% loan growth over the course of the year, even though the H8 data has been showing that it's been trending in the most recent quarter at a 15% annual growth rate. So we think that there will be lots of loan growth. I know there are a lot of market participants who get nervous about that, thinking loan growth in front of a possible recession is a bad thing. But I'd like to remind everyone that we're seeing a cessation of paydowns. We just went through a period of time where there were record paydowns. So the origination machines inside the banks is still performing very well. We're just not seeing the payoffs and paydowns that we had seen in prior cycles. Also, there's going to be a lot of focus on what's happening to deposits. The Fed H8 data shows that deposits have been declining at an 8% annual rate, which is a bigger decline than what we were looking for. I think that'll impact a lot of the bigger banks and also some of the specific ones who have really been holding a lot of the liquidity that had been around since the stimulus program during the global pandemic. So these are some of the trends, but I think the theme in the core spread banking business is going to be positive operating leverage. And that's probably going to be the case in the second quarter and in the near term. And then it'll probably ebb as we get into year end, as the pace of increases slow a little bit, as well as deposit betas start to catch up with the industry a little bit more. But we think that the core banking business will produce pretty solid results here in the second quarter.
And Tom, one of the topics you didn't touch on in detail was credit. I know there's a lot being written and talked about going into the second quarter earnings about where provisions will wind up. Obviously, credit has been holding up really well. And just any thoughts around what you're expecting? We did a recent survey that shows that maybe as much as 2/3 of banks may have some sort of provision in the second quarter, but just wondering what you're looking for.
Yeah, we are looking for banks to have a provision in the quarter. We maybe think that you might see something in the neighborhood of, let's say, 10 basis points relative to the loan portfolio, as much, and that's really coming off a level where it was near zero. Hold on one second. I do want to double check the provision expense here. I'm sorry, it's 8 basis points is what we think it'll probably be in the second quarter for the industry, and that is off of essentially 1 basis point or zero in the first quarter. So we too do see a pickup in provisions in the quarter, but I think interestingly is that we do expect credit to remain generally pristine. The surprise, though, should not be that non-performing assets are going to go up as the year unfolds. It should really be as to for how long a period of time there's been no credit disruption to the industry. Banks really weren't built to underwrite, in my opinion, to a zero non-performing asset ratio, and so we're likely to see a pickup and a little bit of a normalization along the lines of non-performers and provisions. We just went through a really remarkable period with COVID and the introduction of CECL and how heavy the provisions were. But as a lot of the economic models start to show the economy slowing, we think that is going to work its way into bank income statements. And we do have provisions moving up to 0.23% in 2023. And that's one of the things of the quarter that we think that investors are going to be looking for. They're going to want to know if their forecast for any increases in or the increases in provisions, if it's going to be at the appropriate pace. But we don't think that the second quarter is going to be the quarter that investors or participants may look at as the quarter where you saw a turn in credit quality, for example. We expect a modest little bump up, but that any stress that may occur is more likely to happen in the second half than we think in the second quarter. And areas that we continue to keep an eye on is we're keeping a close eye on any kind of subprime lending that had happened. And a lot of that has happened in the shadow banking industry away from the banks. And that would be a slightly different story. We do think as the year unfolds, you could see consumer delinquencies rise, especially in the subprime area, and especially in the shadow banking arena that's away from the regulated banks.
Excellent discussion of the big picture and the quarter, Tom. Maybe talk a little bit about M&A. Obviously, last year, significant number of deals announced and closed, and slowing through the first half of 2022. But as we look out over the next 18 months, maybe just get your views on the deal environment.
Sure. So I think the first thing is that, remember, the industry's in consolidation mode, and that's been the case for several decades. So the natural state of things is that the industry's consolidating. The pace has really slowed down, which doesn't surprise me because generally you need orderly to have banks combine on a healthy basis. And the stock prices have not been orderly. The change in the economic outlook with Fed policy and inflation and what's been happening in Europe with the war and the energy crisis, that is not orderly. So I'm not surprised that activity has slowed down. We are still seeing some of the smaller banks in the industry continuing to consolidate. And my instincts are is that will continue. But I think in the larger bank arena, I don't think you're going to see an environment that's going to be that active until we get a little bit more stability in the stock prices and comfort in the outlook. But I also think the next 12 months are going to be very interesting to see how the class of 2021 is performing. Because like you said, Peter, there were a lot of really notable deals from last year. A lot of those deals, most of those deals have closed. And now the market's going to get a chance to see how the performance is. And one of the things that I like is that, and it's a stock that we like, M&T, for example. It's a stock that our analysts have been recommending. Stock is up on the year. It's outperforming. And I think it's for a variety of reasons. I think number one is M&T's done a very good job of managing their operations. But number two is there are benefits from the People's United deal that they recently closed. And I think as you look around the market, there are other examples like that where there's consolidation opportunities and expense savings opportunities and scale opportunities that continue to enhance positive operating leverage. And it'll be interesting to see if those stocks and those companies do outperform over the course of the balance of 2022.
I'll maybe touch on a couple of technology related topics. Obviously, everyone's following what's gone on in the digital asset crypto space with prices, and maybe just get your thoughts on the crypto market, and then maybe just sort of it operating outside banking versus maybe inside banking regulated environment.
Sure. So I think that one thing, and I love to look at things on a multi-year and even decade-long basis to see sort of what happens after certain catalysts or events. And remember, during the global financial crisis, when the investment banks were being impacted with financial stress, there was immediate response on the behalf of regulators to make investment banks banks. That happened overnight. I believe there's going to be a similar response around crypto, but I don't think it'll happen overnight. It'll happen over a longer period of time. But I believe that with the speed at which some of these companies have failed and some of the financial stress around some of these crypto companies, that it is going to accelerate and enhance the policy response around regulation. And I would expect that there's going to be more of the crypto activity that's going to be inside the regulatory barrier rather than outside of it post this crisis. So, and there are some banks that play a role already, whether it's Signature Bank, it's Silvergate Bank, that are providing liquidity to some of the exchanges. It'll be interesting to see how these companies perform relative to some of the companies outside of the regulated banking system. Now, granted, they do different things and they take different risks, but my instincts is that the bank performers are going to be superior performers. And I think it's because of all the regulation and history and credit culture and policy and regimes and liquidity and capital that already exist inside banks. So I would believe that over time, more of this activity is going to head towards the banks, or maybe as the regulation gets written, there'll be another regulator that gets more assignment to this space. But I would expect more regulation to be coming down this avenue. And I'd also go back to the president's working group that issued a report on stable coins, where it basically said stablecoin should be either issued by a banking regulated entity or an entity that's regulated by a banking regulator. I think that was an early indicator of where things were headed even before the current stress showed up. So that's what I think. I think that this is going to be used as an example for more regulation, which I think in the long term will be good for the market. It'll be good for crypto, and I think in many ways it'll be good for the banking industry as it continues to be viewed as an island of stability.
Tom, maybe sticking with that discussion and broadening it to fintech. Obviously, valuations have come down, and lots of partnering between traditional banking and fintechs competing on a standalone basis. You mentioned shadow banking before, but maybe just views on the fintech market as we go through this cycle coming up here over the next couple of years.
Yeah, so fintech, first of all, I think the biggest development in the fintech space is what happened during COVID. We had tremendous adoption during COVID, where market participants, institutions, essentially in a matter of months, moved towards fintech at a rate that historically had been done over a course of many years. So I don't think we're going backwards in terms of market acceptance, customer preferences, big bank, big company usage. So that's here to stay. That's permanent. And I'm seeing a lot of the banks really invest a lot of money to go down this path to make themselves more profitable, hopefully safer with better intelligence, and also more accommodating to their customers through the use of fintech. So that's here. What has really changed, however, is the market support for unprofitable or non-profitable growth companies. And there's just been a recasting of the valuation. There was a market reports that Klarna had done a financing recently where their previous valuation, according to market reports, was north of $40 billion. And the most recent financing was less than $10 billion. That is, and that's one of the leading technology providers of credit in the market. I think that's a signal to the degree to which investor appetite has changed. And I think what that's going to do is it's just going to change a lot of the dynamics. I think it could lead to more consolidation in the fintech space. And I also think that it just proves the fact that the banks who have very good core earnings power are not going to be as disrupted as many of the challengers thought at the beginning of the evolution of fintech. So I think that is a big, important market dynamic. There are still many terrific, fast-growing fintech companies that I think are going to be very successful. We just have to go through a little bit of a shakeout and a recalibration on valuations as we reset the market here with investors.
Tom, we entered 2022, things seem much more clear and maybe much more positive than where we are today. So thanks for sharing your forward-looking views in an uncertain time, and really look forward to continuing the discussion in early October.
Terrific. Thank you. Great to be with you, Peter.
Thanks, Tom.
Thank you.